people. So we've got quite a lot of interest in this fund, which is great to hear. And we personally are super excited to be launching this new fund. We haven't really been bullish on the macro environment in many years. You know this if you've been watching us. Certainly we've had some select opportunities that we've come out, but not enough to really launch a dedicated fund in this category. So we finally have a market that feels like it's showing signs of a recovery. And our job today is to give you our insight about what's going on in the market, insight into this fund, and answer the most important questions you have. How does the fund work? Why Origin? Why now? Why will this strategy produce good risk-adjusted returns? So Dave and I are going to answer all those questions and more. We're going to present for probably the next 35 to 40 minutes. I'm going to cover the fund strategy, go over Origin's capabilities, our track record, and go over the mechanics of the co-invest feature of this fund. I'm going to hand it off to David, and he will cover current market fundamentals and two deals that have already been sourced for this fund. So I am having some camera issues. If I do end up going blurry, I'm going to have to jump out for a minute and reset my camera. So not sure what's going on, but we'll handle the technical difficulties if they come up. Once Dave is done, we're going to open it up for everybody's favorite part, the Q&A. So I am going to jump in. I think everyone has looked at the disclaimer screen long enough. There's the Select Asset Fund. And I'll start with strategy. This is going to be a $100 million development fund, and it'll invest in 5 ground-up multifamily development deals. And one of the reasons we're calling this the Select Asset Fund is because we are limiting the fund investments to only 5 deals. We want to be able to invest money quickly over a single vintage. So all of this investment capital will be put out in 2026. The projected net IRR of this fund is between 14% and 18% over about a 4 to 5 year period. And that equates to a net multiple between a 1.55x and a 1.7x. So in that early period, this kind of next 4 to 5 years, what I'll call the initial period of the fund, there will not be any cash flow. All the cash flow will come after the initial period. What you see in front of you is really what I would consider base case underwriting. Dave and I were talking, and if this fund ends up producing a 1.5x on the multiple, we're going to be disappointed. We really believe that there's an upside scenario above a 2x here that's more than realistic if the tailwinds that we're starting to see today begin to accelerate. And something brand new to this fund is a co-investment feature that allows investors to invest alongside the fund in deals that require additional equity and pay no fee and no carry. So the co-investment vehicle, I'm going to go into it in a lot more depth in a few slides. We know that there have been a lot of questions about that. I'll talk about the mechanics and how you also qualify for that no fee, no carry. This is a called capital fund, meaning you commit your capital and we call it as we find deals. But the good thing about this fund is it's very short in duration with a total lifespan of 5 years, and that includes the capital call period. So most capital call periods in a fund are 2, 3, maybe even 4 years. The capital commitment period in this fund is only 1 year. And it's likely, kind of more than likely, that we call all capital in the next 9 months based on our current pipeline. And that was one of the reasons we wanted to keep it small. We wanted to keep it select. We wanted to keep it vintage based as well. And so once we have called all capital, the remaining fund life is only 4 years. And that's plenty of time for us to develop and stabilize all 5 assets in this fund. And that 4 to 5 year hold period, the way we decided is it sort of maximizes the IRR. And also the multiple is very healthy at that time point as well. But if you want to be in the fund and stay for IRR, you can. If you want to continue, there is an optional hold period in this fund. So you don't have to get out at the end of that 4 to 5 year period. We've built in an optional hold period. So at the end of 5 years, you can exit the fund entirely, part of your investment, or you can stay in. And what we found is this structure appeals to both those who want to exit and those who don't. Number one, it eliminates the fund tail for those exiting. And what that means is that you get all of your money out at once instead of waiting for us to self-fund assets over several years. And the fund tail, if you've been in private equity, it's not funds. Sometimes these funds can be 7-year funds that go on to 8 to 9 to 10 to 11. And assets are just, get stuck in the fund and they're not sold for several years. So that's a huge advantage. All your capital is working sort of those during 4 years, and then you get it out all at once. But we also know that many of our investors, they don't want to sell. They want the income, appreciation, and tax benefits that real estate offers, so they have the option to stay in. This is not a decision that needs to be made today. It's an option that you should know about, and you can decide in about 4 to 5 years. So why Origin? We have been in business now for 18 years, and we focus exclusively on investments in the multifamily space. We develop, we lend, and we acquire deals. And I would say that our collective experience across this one asset class, we're up and down the capital structure, we're across different strategies, we've done everything from value add to development, different markets. It leads to better decisions, and it also leads to a deeper pipeline of opportunities, and both are important when it comes to generating returns. And we've generated, if you look at the upper right column there, we've generated roughly a 20% IRR on our development deals and a 1.19x multiple on invested capital since around 2015. And I'm going to go deeper into that track record on the next slide, because this is sort of an aggregate number, break those out into 2 different time periods. But we've never lost money on a multifamily deal. Most managers in this space would have been able to make this same claim 3 or 4 years ago, because we had a hell of a bull run from 2010 to 2022. But the last 3 years have really been one of the toughest multifamily markets in the last 20 years. And it put everyone to the test. And many of you know this, because if you're on this webinar, chances are you've invested with us or you've invested in real estate, and you've seen firsthand good managers, bad managers, what it means. A good manager needs to be able to capture the upside when times are good and protect the downside. And you really understand, like, when things go up and then they go down, who's using just financial leverage, who's actually managing risk. And these last 5 years have really highlighted the managers who can do both. And I'm proud that we are in that category. And I equate that to a few things. Number one, we're what I'll call obsessed with risk mitigation, risk management in every deal and the way we operate the business. And there's a saying I personally love, it's take care of the downside and let the upside take care of itself. And we live this concept. We are constantly talking about downside risk, not how much we can make, but how much we won't lose, right? In deals. And the absence of loss isn't always gain, but we've shown we've been able to do both. Second thing is we have a great team of people. Our senior leaders on the real estate team have been with us on average for more than 10 years each, which speaks to the collective experience I just referenced. And then lastly, I think we've been able to outperform because we use data and information to help inform decisions. And if you've been on previous webinars, you've heard us talk about our data science team, Multilytics. Their job is to forecast rent growth in our market. And this information, it ultimately helps filter out deals and point us to markets that have the highest rent growth potential. Because rent growth is highly correlated to investment returns. If you don't have rent growth, it's hard to make money. If you do have rent growth, things tend to work out a lot better. So we've spent a lot of time and money and effort in this department to differentiate Origin, and it's worked. Development returns. I said I was going to break this down. This is development returns by vintage. And what this slide is showing is a breakdown of our returns really over 2 distinct periods of time. On the top left of the chart, you see the time period from 2015 to 2019. And this is what we would consider a normal market. The variables that impact real estate investing, they were sort of isolated to an historical band. Rent growth was 2 to 4%, maybe 5% was an outlier, 1% was an outlier. Supply was reasonable. Interest rates oscillated between, sort of 1 and 3%, but by not much. And expenses sort of grew by inflation. So underwriting deals was much, more in line, and a couple of variables could get out of place, but other ones would offset those. And during this period, our average multiple was around 2.5x. And the IRR was right around 30%, with our worst development deal being around 14%, and our best generating a 45% IRR. So you can see sort of the downside and the upside tails during this period. And if we look at the next period from 2020 to 2024, that was anything but normal. Every variable that matters to valuing real estate and generating returns was a headwind during that period. Interest rates skyrocketed, cap rates went up by at least 50%, depending on the market you were in. Construction costs rose by 20 to 30%. Insurance costs doubled. And we're now working through record supply. The only saving grace during that period was that rents also skyrocketed and they soared with all those costs. And that helped immensely. In that period, when we isolate our development returns, we were still able to achieve IRRs somewhere between 7% and 20% with our, that was the range. And when I look at this, there are really two takeaways. One is really to better understand what we as a manager were able to achieve during this downturn. And the other thing is to sort of look at that 2015 to 2019 period and to understand what is possible in a more normalized environment. And the reason why I said earlier that there's an upside tail here is because we believe the next 5 years is likely to look more like 2015 to 2019 rather than 2020 to 2024. And vintage, it explains a huge portion of return dispersion in real estate returns. And we're always looking at data and information that's being published. And the best times to invest in real estate are coming out of a recession when the market is starting to go up on an upswing. And this fund and future funds like it, this is going to be a series of funds, the Select Asset Series. They're really meant to be vintage-based funds. So individuals have exposure to single vintages rather than a mega fund investing over multiple of years, because when you're investing over years, you have a bigger chance of investing in both good and bad cycles over those 2 to 3 years. So here's how the co-invest works. We are giving investors the opportunity to co-invest in the fund's deals at no fee and no carry. Yes, no fee and no carry on deals that are too large for the fund. And the reason why this even exists is because we want the fund to be equally diversified across 5 deals, which limits its exposure to around $20 million in each deal. If we have a deal that requires $35 million, $15 million will be made available to investor via a co-invest vehicle. So this isn't going to be a deal by deal that you'll get to choose, but it's by a vehicle that you commit to upfront. And in order to qualify for the co-invest, you either have to commit $500,000 to the fund as an individual or $2.5 million in aggregate commitments as an RIA. So what that means is if you're a wealth manager and your clients come in collectively for $2.5 million, we will allow you to make a separate co-investment commitment in the fund. And so understand, though, that this is an additional commitment. This isn't you don't take your investment and split it up into the co-investment in the fund. So if you invest $500,000 in the fund, you can commit another $500,000 in co-invest dollars as well. Now, that doesn't mean you will invest 100% of your co-investment commitment, because we don't know how big that vehicle will be or how many people will be participating, but you will get your pro rata share. The fund itself is going to be $100 million. So we estimate that the co-invest vehicle is going to be around $50 million. So if you're investing in the fund, you can kind of estimate that your, co-invest will be anywhere between, if you go up to that 1-to-1 where you commit $1 million, you commit another $1 million to the co-invest, maybe 60% of that gets called through the co-invest sleeve. And it's truly a great perk. It essentially reduces your fees by about 1/3 and increases your blended returns, which we show on this page right here. So this is the last slide I'm going to cover before I hand it off to Dave. But what you see in front of you is a graph of the returns and the blended returns with the co-invest. So, the fund only is the bottom line. The blended returns are the top line. And if you invested $1 million in the fund and you did no co-invest, then the base case return multiple is a 155 in this scenario. If you split that $1 million up and committed $660,000 to the fund, and you invested, I'm not sure what that commitment needs to be to the co-invest, but you were able to invest another $340,000 so that it equates to $1 million, your return here would be about a 1.7x multiple on invested capital. So the co-invest, it decreases fees, it increases your returns by about 25%. That difference between 155 and 17 is pretty, or 15 to 17 is pretty significant over that first 4 to 5 years. And investors will do well in the fund, but if you qualify for the co-invest, I highly recommend you take advantage of this because it does enhance returns, lower your fees, does everything. So I'm going to hand it off to Dave now, and I will be back during the Q&A. I think you're going to really find his portion especially compelling as he covers some of the tailwinds starting to form in the macro environment, and he will also cover 2 of the deals in more depth that have already been identified for the fund. Thank you, and I'll see you in a few.
Thanks a lot, Michael. I'm going to jump right in. You were amazing with timing. So we have about 15 minutes to get through my slides, and we'll cover plenty of Q&A. And I'll get ahead of this for a moment. We'll stay on as long as you have questions. There's nothing more important we can do than communicate with you and make sure that you understand every detail of the fund. If we don't get to your question for whatever reason or don't answer it in the detail necessary, email us, and that'll be on the slide, and we mean it. I won't say it because you'll be able to see my email and Michael's, but we'll handle that at that point. So I'm going to really cover in the beginning why now. And if you're in some of our funds, you've already seen probably some of this data. If you're new, something really extraordinary has happened in the last really 3 years. If you look at the bar graph at the bottom, what's happening is the cost to own has skyrocketed relative to the cost to rent. How much? By about 64% nationally. And the bar graph below really is showing you when it happened. Because, in 2020, 2021, it was a non-issue. It was about the same. And then you can see that it's a very recent thing. And so, why? The reason why is the price of homes went up quite a bit. And then the price of taxes, which are a sort of derivative of the price of the home, the price of insurance, and then importantly, the mortgage rate went up without the corresponding decline in home pricing in the for sale side. At the same time, the cost to rent really is flattened. It went up quite a bit in 21. And then from 22, it steadily has gone down, and it's been essentially flat for 3 years. And so in the rental market, we actually have this extraordinarily strong tailwind called affordability. It's very affordable now relative to your wages and what you earn to rent. And that should make sense because your earnings, your wages have gone up in the last 3 years, but rents haven't. And we've seen in our markets, in general, that ratio used to be about 30%, meaning people would pay 30% of their income for rent. And now it's more like low 20s. It's at a place where, and that's important for this fund, because people who can afford to pay more rent, we can charge them more rent. And that's another tail. However, in the for sale side, that's just not true. It's 64%. And so the rational actor would rent before they buy because it's so much cheaper. And then there's just an awful lot of people that make really good livings and they actually can't buy. Maybe they want to buy, but they can't. They don't have the down payment. They don't have this kind of money. And so what you're seeing is lots of segments are moving, and I'll cover this later because our demand has never been higher for rentals for lots of reasons. Even at the super high end, by the way, these are people that absolutely could buy. The amount of renters who are millionaire renters has doubled in the last few years. And so there's all sorts of tailwinds that are sort of adding to the demand curve, and I'll get to that. Multifamily starts, that's our supply. So when we're talking about the cost of rent versus own, that's a demand function. This is obviously a supply function. We had extraordinarily high supply in 21 and 20, really caused by the 0% interest rate environment. And we're still working through that. That's why rents are flat. But when you look into what happened, like the Fed started raising rates in 22, 23, 24, and you see this precipitous decline in starts. And this is what this is measuring, multifamily starts, down 30%. And it sort of hit its low in 24, and now it's inching along the bottom. It's marginally higher. But in general, you're 30% lower. Now, keep in mind, the U.S. is underhoused by millions of units. It depends on what source you use, but anywhere from, it's a very broad range, but let's say from 2.5 to 5 million housing unit shortage. And now you're not starting nearly what's necessary to make that up. Now, when you talk about supply that starts in 23, 24, 25, you have to go 3 years out from that. That's when the supply actually is built and is rented. So the lack of supply that started in 22, 23, 24, that doesn't show up until really 25, 26, 27, 28. I'm not certain, no one is certain, what demand looks like in 27, 28, 29. Anyone who tells you that, that's not true, because we don't know what the economy is going to have to deal with in the coming years. Maybe they're tailwinds, maybe they're headwinds. We don't know. We do know that there's going to be a supply shortage because there just hasn't been enough housing starts for 3 years in multifamily. That can't be changed. The starts that should have happened in 23 did not happen. The starts that happened in 24 did not happen. And that will be a tailwind. Like, that part of the equation is already set. And this follows up on the record demand. Yes, it's a function of the rational actor would choose to rent. It's 63% cheaper. Of course, they would do that. So record demand, 794,000 units of demand. I anticipate that this will increase, with the only exception being an exogenous shock we don't see. So all things equal, I expect this to continue to go up. Some things that could change that: a severe recession that limits household formation. We saw that in 08 and 09. But the point is, when you're looking to invest, you're looking for the most probable outcome. The most probable outcome is supply is going to decline quite a bit and demand is going to remain strong. And the only way to rebalance less supply at a high demand unit set is at a higher price. And that's another just way of saying your rents are going up. And that's what we anticipate. And that's what Multilytics also sees. This is really interesting to Michael and I, and it actually, it reminds us of a lot of when Origin started. Origin, we started in 07, but we really didn't start investing significant capital until 09, 10, 11. And the point of this slide is, it's really important to understand outperformance in multifamily, and it usually comes after a period of underperformance. And so if we had extended this graph, and perhaps we should have, but in 08 and 09, you had a negative performance area. That's the Great Recession. And multifamily didn't do well. It had negative returns. And then coming out of 09, you see 10, 11, 12, 13, 14, multiple years of very high returns. And just to be clear, these aren't development returns you're looking at. These are core returns, just owning buildings. And that's the cash flow and appreciation component. Development returns in these times, Michael shared with you. We were doing mid to upper 20s, even 30s, 40s types IRRs in these times, because that's what was available. This is development fund, so I need to anchor this slide. The returns are quite good, but this is the beta, or just the market trend, the tailwinds that you see. Well, what's the point? The point is, we had a negative period in 22 and 23, and that shouldn't be surprising. We were coming out of the most supportive Federal Reserve policy ever, 0% interest rates, and they reversed, and they increased interest rates 525 basis points in 2 years, and you had this negative period. We believe that the years to come are going to look a lot like 2010, 2011, 2012, 2013. Keep in mind, we're doing development. So if core is doing 10 to 15, you should get another 6 to 1,000 basis points for the unit of risk for development, i.e., if this fund, I know that we're showing you 15 to 17, but I will tell you, and Michael and I were discussing this yesterday, we've been doing this a long time. And I believe what we've seen in the last 3 or 4 years, that's the stress test of development. We're quite good at it. And it's been a really difficult market. And the worst you're going to do is what happens. We've done 9 to 11 net. That's your downside. And I think the upside, you see through our returns in previous funds when the market was a better market, a bullish market. And so I don't know what this fund will return, but the band's wide. And it feels to me like 9 is the low and 30 is the high. It's our job to show you something that is our base case, and we do that. But in development, it is a wider band than that. And that's, I'm just being quite honest about that. The variables can move both positive and negative in a development model. Multilytics is corroborating what we see, a bullish cycle. We've broken this out by market, but what I would take away from this is a lot of our target markets show a bit higher growth than the national average. But Multilytics is pretty bullish across the country right now on what it sees. And yes, it's taking in billions of units of data a month. But the big thing that it's doing is looking at units per capita, another way of saying how many units are coming to the market relative to unit of demand. And that's exactly what we just did. It's seeing this imbalance that's coming up in 26, 27, 28. This fund will have 5 deals. Importantly, we already have 3 deals under control. This is not a blind fund. Our teams have been working on these deals anywhere from 3 to 12 months at this point. It's definitely threading a needle because on the one hand, we want to have deals that can invest your capital immediately, but we also need to have equity in order to credibly go out and we'll do what's necessary to control deals. Origin has a balance sheet where we can do some of that work, which is good. And it's the goal that we allocate this money quickly and don't have much of a J curve. I'll go into these deals for a moment, but in addition to the 3 deals, I'll go into more detail on these 2. We have another 2 deals behind that are very far along. So as we sit today, we're probably 60% allocated, but really closer to 80. As long as a deal is still being worked on, it is binomial. So I can't tell you for sure we're 100% or 80%, but we're very well seated through this fund. The first deal, Michael and I and the team have all been out here personally to see. Of course, if you don't know, Origin has offices throughout the country in our regions. This particular deal was sourced from our office in Denver. The partner on this deal is NRP. NRP is one of the best developers and integrated operators that we do business with. We've done business with them repeatedly, and we think very, very highly of them. The asset location is in Chandler, Arizona, which is a very fast, high, and importantly, high demographic income and demo area. And this site is really interesting. Great accessibility from the major highways, great walkable retail, more retail being built, all the things we look for. And then in terms of the cost to build, NRP is a very credible partner in the sense that they have so much development and they have their own GC in addition to the development arm, that they have true economies of scale. And so, if you look at the cost to build versus the competitive set, which, I'm actually speaking to something that isn't on the slide, but they're building here significantly cheaper at the same value set as competitors. And how do they do that? One of the ways they do that is, they're buying inputs nationally, on a quarterly or bi-quarterly basis, and they're getting huge discounts. So when they're buying lumber, they're not buying lumber for a project, they're buying a lumber for 50 projects. And they have quite a bit of buying power and leverage with subs based on their size. And so these are all things you learn through time. We've been doing this quite a while, and this is a partner we like a lot. We also like the margin, and we believe it's a very credible margin. So if you go to the untrended return on cost of 6.4, the thing I would focus on there is, in Phoenix, the spot cap rate market right now is anywhere from 4.6 to 4.9, and so just doing that math, you're very comfortably at a 30% margin, possibly even higher than that, and that's a very healthy margin that we believe in. That's very credible. We'll look at 100 deals to do one, and most of the deals we see, whether it's on an equity investment basis or a debt basis, we look at it the same lens. Most of the deals we see in growth markets right now on development are somewhere between 5.2 and 5.6. We would potentially lend to a deal like that because we're protected in the capital structure. This is an equity investment, so we're going to need significantly better margins to get interested, and this deal has that. Similarly, in Vegas, it's actually a quite similar story. We really like the location, the growth of this submarket, which is corroborated by Multilytics. But then you move to basis. Here we're building at sub 300. Comparable properties are building at 350. And importantly, the same level of value is being created. We're not getting there by building a worse project. And so then your question becomes, well, how do you do that? And the answer is, this is the local developer with his own GC. He's known for building at a lower cost structure. We have a relationship with him. We've already done business with him on the lending side. That's what's so wonderful about Origin, is we oftentimes do business with someone on one side for one firm, one fund of Origin, and then at least something else. But because he's local and he's to scale at a local level, he's only doing business in Vegas, but he does quite a bit, and he has his own subs, et cetera. Also credible in terms of being able to deliver a very well done and a well-constructed building, but just at a lower cost. And we've seen that through the lending side, that it's actual, it's real. And so we're really excited. And again, when you can enter a market at a lower basis, it protects you, but it also produces the outsized returns. That's how you get to 18 to 20. That's how you get to that 6.4, which again, it's north of a 30 margin, which is quite high. Most of the things we see in Vegas are, again, 5.2, 5.6, somewhere in that neighborhood. We won't do a deal like that, but there's plenty getting done. And so the nice part about this fund, we only have 5 deals. And so we can truly leverage everything that we do at Origin to find the needles in the haystack, the deals that get Michael and I and the team excited. That's why we got into this business, is to have that feeling when you find a deal that, you looked really hard to find the right deal, and you get this feeling that you're really creating value just through the execution of the business plan. And I do feel that way about both of these deals, and they're indicative of what will go into this fund. A little bit about Origin. If you're on our website ever, we have our returns. It's just one of our funds, but importantly, it's our multi-strat fund. It's called Income Plus. Why am I sharing this? Well, Income Plus has development in it. And if you look at our returns, we're beating our competition, including Blackstone, Starwood, all of the large players, significantly over the last 1, 3, 5 years. And there's a reason for that. Our investment management team, because remember, we need a team that can both execute the development phase and then segue into executing the operational phase. And so those are different modalities. And we have experts in the various modalities. We have experts in construction. We have experts in development. We have experts in operations. Here, we're focusing more on operations. So in terms of RevPAR per unit, we're pulling more cash per unit than our competitors. Well, that's important. That helps you service debt. It helps you distribute to equity dividends. Our reputation management, our properties are scoring 26% higher. That's really important than our competitors, because a lot of the times the search process starts with reputation. Okay, well, what's this building? How's it being reviewed? Is it positive? Is it negative? How positive? It's a big part of that lease up cycle. And then in terms of expenses, really important and oftentimes overlooked, if you can produce more value, higher revenue per unit, higher ratings at a lower cost structure, well, that's really important. If we were lower in cost structure, but we weren't getting value from it, that's not a good idea. But if we're doing it leaner, that is a good idea. It produces more net operating income. So these are all things we're sharing with you, but I'll also tell you, all these metrics are how investment management is evaluated and ultimately bonused. I mean, that's how, if you're on the investment management team, you will be reviewed and ultimately bonused, both as a team and as an individual, because that ultimately is how we can show you, the investor, we're actually better at what we do. And I can't, just as I don't know what the economy is going to be in 3 years, I also don't know what the total returns in real estate will be, in multifamily real estate. What I can control, and what Michael can control in our team, is how we do to others on a relative basis within what we do. And we're quite proud of that, because we've done better significantly than really good operators. When I say we're beating Blackstone, they're very good at what they do. And we've done better, like significantly better. So the fund terms, Michael and I talked about this. I'm going to touch on a few, but I don't want to go one by one, because I see we only have 20 minutes left, and I want to value your time and move to Q&A. He went over the co-invest already, so I'm not going to do that. It is a $100,000 minimum, and so we get that question a lot, so I do want to touch there. And then the other thing I'll say is, in terms of management fee and performance fee, we're on the low end, and that's not the blend. If you elect to do the co-invest, then we're below the low end. But even just if you just said, hey, I just want to be in the fund, I don't want to do the co-invest, I don't know what my future buying power is, or whatever it is, we're already on the low end. Like I would challenge you to find another development fund that doesn't have a 20% promote. Ours is 15. If you do, send it to me. I'd like to see it, because I think there's very, very few that exist. Now, that wouldn't matter, but I'm telling you, I think we're very, very good at what we do, and I think we've presented that. And so I think you get a lot of value, and I think we're very fair in terms of our fees. And then the last thing I'll say is, obviously Michael and I will co-invest. We always do. And we will co-invest, and we'll also participate in the, I guess I'll call it the co-invest of the co-invest. And with that, I'm going to send it back to you, Michael, and maybe we can alternate on Q&A.
That sounds good, Dave. How's my camera?
Perfect.
Okay. All right. I saw your comments. Apparently I blurred out there a couple times. Okay. So I'm going to tackle some Q&A here. Jade asked the question, are multifamily concessions still elevated? How is rent growth trending? What is your 2026 outlook? I think David answered a lot of this in his outlook, but there was another chart that we actually omitted from these slides that shows the markets that are in the recovery mode versus the markets where rents are still declining. And categorically, almost every single market that we're looking at is either in the recovery or within a couple months away from the recovery. And it has to do with what David was showing on that screen about how demand right now. And so, to many, home ownership is just not something that they can afford. And renters today are getting, 2-3 months in some places. But when we're in the market, and I was in Phoenix last week talking to the managers, you can kind of feel the optimism in their voice, right? market traffic is picking up, leasing traffic. Concessions are going from 3 to 2 months. So we're starting to see these things. And I think it's important to note that when we're talking about getting off the ground in 2026, we are not going to be leasing until 2027 and 2028. So you have to use a little bit of foresight to see the existing demand, how the new supply has fallen off a cliff completely, and triangulate this to where it is in the future. And so that's what we love about kicking this fund off now, because delivering in kind of late 28, early 29, we think that market is going to be a market for landlords.
All right, thank you, Michael. I'll cover too. So, Lewis, thanks for your question. I think your question is, can you 1031 income plus gains into this fund? I believe, and if I'm wrong, ask the question again, or we can handle offline. But the answer is no, you can't 1031 into this fund. We do have a 1031 product as well, and so if you have interest there, contact me, Michael, and we'll refer you to the team that does that. The next question is from Rob. Rob wants more clarification on the IRR versus multiple calculation. And Rob, email me at david@origininvestments.com. And I think if I go to the next slide, there it is. Sorry, I didn't do that. Email me or Michael, and we'll walk you through it. There is quite a bit of math behind it, but thank you for that, and we'll follow up on that. Go ahead, Michael.
Yeah, Rob asked the question, compare this risk to the Income Plus fund. Also, how long is the optional hold period? How tax efficient compared to Income Plus? This is a higher risk fund, Rob. It's also higher return whenever you're in development wholly. It's going to be more so, and it's also going to generate commensurate returns. Once you're done, commensurate returns with the risk you're taking for development. Once you are done with that 5-year period, the fund does reset. The fees reset. They actually go lower. I believe there are 6% pref and a 10% performance fee versus where we are today. And then you'll be in this portfolio of 3, 4, 5 assets, whatever it is at that time. We might have to sell to get some people out of those assets. And you will have, it'll be K1 based, so you'll be in a partnership. We've talked about actually putting a REIT in place at that time. We're not sure. We'll have to talk to investors. It's still 5 years out. This fund doesn't have a REIT on it today, but it'll be extremely tax efficient. You'll generate income, future appreciation in that fund. And one thing, we've gotten a couple questions about this. We're really thinking about merging this with Growth Fund 4. We would have to get permission from those investors because that was never contemplated. But I think there is a benefit to all investors. Number one, people are more diversified once that happens, right? Across a greater number of assets, people can be in a fund of 6 or 7 assets versus 3. That's the other thing. And then we might also merge it with future funds as well in the select asset fund series. So those two things are things we're thinking of. But when you have a bigger fund, it also helps to amortize operating expenses. So it's better for investors. We just haven't gone that route yet, but this is something we're thinking so that the fund doesn't diminish into 1 or 2 assets itself.
Okay, great. I'm going to answer Hugh's question. What is the minimum investment? It's $100,000. Hugh, thanks for your question. Back to you, Michael.
I'll grab. Kevin asked, when subscribing to the fund, do we have to quantify the size of our fund commitment plus our co-investment? Kevin, good question. Yes, you do have to quantify both. So you can think about this being 2 funds in one, that you're going to make a commitment to the fund and you're going to make a separate commitment to the co-invest vehicle itself. And again, we're not doing a deal by deal like we've done in the past. It's too taxing on our team. We've also found that investors don't really want to sign 5 different subscription agreements. There's a lot for our legal team to do, and it's just more, it's more expensive to manage it that way. So we find that this is much easier. And if you like what you see in the fund, by the time you subscribe to this fund, it's very likely that you will see 60 to 80% of what is going into the fund. Dave went over 2 deals. We have some other deals that are very close to getting to the finish line. So you'll also know what is in that co-investment side as well. But you're going to subscribe to the fund and the co-investment vehicle at the same time.
Okay, I'm going to take a couple because Michael, you're a bit blurry right now. So I hope I get this right. Scherer, and I apologize if I didn't. The question is, will the properties be absorbed by Income Plus? No, they're actually going into their own vehicle, much as Growth Fund 4, if people elect to stay in that fund. And that'll be a core vehicle only because it'll just be these stabilized properties. There'll be plenty of depreciation to offset income. And to Michael's point, he said earlier, we may elect to add a subsidiary REIT to block dividend tax further. That's where these will wind up. And I'll answer Dan, but Michael, you're clear again. But Dan just wanted to say, you're a valued investor. Thanks for the question. His question is, and I'm going to just make it a bit more concise. He's concerned that housing, both, I'm assuming you mean rental and for sale, is too large of people's income, and that will cap rents in the future. And obviously, we don't know the future, but I can just tell you my opinion, and that's why I covered affordability ratios. Affordability ratios in rent are quite good right now, and they've changed quite a bit over the last 3 years. So affordability nationally obviously varies by market, is in the low 20s again, which historically is a very bullish signal for future rents. Correspondingly, in 2000, it was approaching 28-30%, which is much, much different. And so I don't share that concern, but that doesn't mean you're not right or it's not a valid concern.
Dan, great to hear from you. Thanks for the question. I'm not going to add to what David said. I'm going to, hopefully I get this name right. Gulzar, do you think that the greater Phoenix market is being overbuilt? I live in Scottsdale. Gulzar, no, would be the quick answer to that. But there are certain pockets that you have to be aware of. And this is, having a team on the ground, having multilytics, being idiosyncratic around the individual deal. There's a lot that goes into that decision. And you can sometimes get a little caught up in the macro or, and talk yourselves out of deals. And I'll never forget, I've said this on previous webinars, but David and I were in Nashville 10 years ago. And we decided not to invest because of all the cranes in the sky and the supply coming and everything. And 3 years later, the headlines were they can't build them fast enough. And it was the greatest bull market ever. And personally, I'd rather be in a market where there is demand and there is building than a market where there are no cranes right now. So we're bullish on Phoenix. There's a lot going on the job front there, like it a lot. And we think there's a lot more room to run there. So glad you live in Scottsdale. My son is in Glendale right now. Different reason, but love it out there, especially this time of year.
Ernest asked a question. Thanks for your question, Ernest. His question is really more an observation. He's in development funds, and some of the developers he's working with are asking for additional capital because maybe their budgets were blown or interest rates went up or whatever it was. I agree with you, Ernest. It was, if you were entering a 2020 to 22 development, those were tough vintages. That was kind of our point. And candidly, it's the point of having a fund. We'd like to have a select asset fund on an annual basis. And the reason is, and we tried to show you this, vintages matter. Our 20 to 14 to 19 vintage were quite extraordinary in their returns. And then we reached this kind of difficult period and they weren't. 9 to 11 is not enough return for a development unit of risk. And I'm the first, if you believe that, so do I. We've never asked investors for more capital in any development ever. So historically, we've never done that. There's reasons for that. It's because we're so selective in what we do. It's because we don't use a lot of leverage. It's because we try to do swaps to fix leverage to mitigate that risk during the development period. There's a lot of reasons, but whenever you hit a more challenging environment, it stress tests who you do business with. And I had this conversation today. He's not an investor at Origin, but he's invested in 50 different one-off deals. And I said to him, look, that's not our philosophy at Origin. We want you to be in a fund, really for two reasons. One, diversification, but the other is when you enter a fund, you're forced to evaluate the manager first. And that's what I believe and what Michael believed you should be doing in every deal and every fund is don't look at the deal, really vet the manager and be very convinced that's the team that you want to do business with, and then move to the deal. And the problem with one-off deals is a lot of people, they forget the first part, which is more important than the second part. Go ahead, Michael.
Kevin asked the question about, you mentioned cap rates in certain target markets are high 4%. How does that compare to relevant debt costs? Are we still in a negative leverage? Kevin, we are in negative leverage, but keep in mind that we're not buying core assets in this fund. We're building to a margin. So when we're talking about a 6.5% yield on cost, we're building significantly above where current cap rates are. And keep in mind, too, that cap rates are a function, yes, of interest rates, because the risk-free rate is going to impact the required return in any risk asset out there. But the other thing that is embedded in there is the future growth rate. So we've seen times during the history of real estate where interest rates are well above cap rates, 70s, 80s, during that point, even the 90s, where they're but real estate still does quite well, right? Because you have the growth of income during those periods. And I would argue right now, the reason why we haven't seen cap rates go into the 5s, 5.25, even 5.5 range, even at the peak, they were 5.25 for really high quality assets, is because the market is viewing that there will be growth on the horizon. And if you see above market growth, you're going to be willing to pay a lower cap rate for that particular deal because you'll make up for it in growing income, right? The best of both worlds, I think, is right now where we have elevated cap rates and we have high growth on the horizon.
Gulzar asked a question about our performance versus similar funds. So for funds 1, 2, and 3, we were top decile. For Fund 4, which is a development fund only, it's a bit early because they're not realized assets, and both us and our competitors, we can't tell you what it is because it's not an honest answer until it's done and it's historical. I can tell you that I had a recent meeting with one of the larger institutional investors in this space. And, I shared where we're tracking in Fund 4, which is 9 to 11 net. And we share that. And we shared that today. And they said, well, look, if you're 9 to 11 net on a 2021, 22, horizon vintage, you're going to be top decile for sure. So like I can tell you anecdotally, I think we'll be top quartile, top decile, even at that lower return, because vintage is so important. I think we're going to outperform, but hold us to that. We'll let you know. That won't be official for another year or two, really. But we're pretty proud of our performance in up markets and difficult markets. Jeremy asked a question. Maybe you should answer this, Michael. Go ahead. Why not income plus?
Yeah, Jeremy, great to hear from you. Thanks for attending today. How was the decision made to create a new fund versus put these in Income Plus? How would you evaluate putting more cash into Income Plus versus this fund? They're just different. I think, depending on your risk profile, this is more of a growth fund for people who aren't seeking income diversification, have maybe a small, higher risk profile as well over the next, 4 to 5 years. I do believe that this fund, on an absolute basis, will outperform the Income Plus fund, and then you can stay in for core. So your question about why not put these into the Income Plus fund, the Income Plus fund is only limited to 20% of development, and we have some new deals that we're going to announce that are going into there because we actually recently did sell Monroe and Aberdeen, so we have some cash to invest in new deals, and the Income Plus fund had first choice in those deals, so we've allocated some to that. But in terms, I think they're both going to do well, certainly, in this environment. And you can pick your choice. Maybe it's an and, but if you're more of a risk averse investor, I would say stay in the income plus fund.
John, thanks for your question. How is Origin different than Greystar? Greystar, it's a really good question. Greystar is primarily a property management firm, and so they are hired to lease and property manage, but they also have a fund management side and a development side. And so in certain parts of Greystar's business, they compete with us, and in other parts, they're synergistic with us. And we regard them very highly. We think they're good at what they do and to scale. We partner with them quite a bit when appropriate. And so, they're national. On the debt side, we're national, but on the equity and development side, we're only in the Sun Belt states, Southeast Texas, Southwest. But in general, we regard them highly, and we both compete and partner with them.
Dave, I'm going to start from the top 36 here and work backwards so we can meet in the middle. Derek had a question. Michael mentioned calling all capital within 9 months is the intent to close the fund by mid 26. Yes, Derek, we will close the fund as soon as we hit $100 million. We're not going to increase the size of this fund. We only wanted $100 million, but the idea is that this will be a vintage fund. Mm-hmm. So if we can raise the money quickly, deploy it within that 9-month period I talked about, we will be coming out for, call it Select Asset Fund 2027 in late 2026, and that will then be the 2027 vintage. That's how that'll work.
So we're at an hour, and I just want to let people know if you're planning on staying the whole time, there's probably dozens of questions left. We'll stay on, but I also don't want you to continue to stay on and then say, oh my God, it lasted another half hour. It potentially could. So I'm just warning you.
Well, we'll be succinct.
So I'm going to move to Scott's question. Can you elaborate on the optional income target return? Absolutely, Scott. So we're giving you the option to either get out after the development period or stay in if you want to continue to have your capital multiply in a tax efficient way. And it's the same thing we did in Growth Fund 4. If lots of people elect to stay in, it just becomes a core fund. Now these are built buildings that produce cash flows, and you can depreciate them, so they'll be very tax efficient. And importantly, you won't pay taxes because we're not realizing a capital gain. One of the lessons Michael and I learned early on was if you produce a lot of profits and then you pay taxes on them and then you just reinvest them post-tax, that's very destructive to wealth building. And so, you have to kind of think to yourself, well, if I'm gonna sell it and it feels really good and I get my money and I get my return, but I actually like Origin and then I'm going to go reinvest it there, that's a difficult strategy because you're essentially losing 23% and then you're reinvesting, the remaining 77 rather than letting the full 100 multiply. This is really the same logic of why you would have an IRA or a 401k. Michael, why don't you go ahead? You are a bit blurry again, but your sound is beautiful. So
okay, great. I don't know. I keep hearing my phone do funny things. Tom asked the question, what is your opinion about Ray Dalio's warning about investing in real estate? Ray cautions against real estate, interest rate sensitivity. Tom, I'm fairly familiar with that thesis, and it's shared. Neil Howe also wrote a book called The Fourth Turning, and I subscribe to an economist, John Malden, which is a pretty good one, and he sort of sums them up. And I respect Ray Dalio, and what we don't know on these predictions is A, if they're accurate, B, when they're going to happen. It might happen in 5 years, it could happen in 20 years, it could happen never. He does talk about sort of a beautiful reset. I would say that if you're, this is one of the reasons why you want a diversified portfolio. Why, I'm sure that you're in gold, the debasing or the devaluing of the dollar, things like that. I think real estate is a great asset class to be in over the long term, especially multifamily. And it's shown to produce some of the best risk-adjusted returns of all sectors, right? Because it tends to be more resilient. And we're not using an insane amount of debt here. After the development, will use fixed rate debt, so we're locking that in. But please feel free to email me that. I'm not exactly sure about his comments about real estate, but I've seen these things. I think David and I are familiar with every sort of thesis about what the future looks like, and you have to make sort of a decision. If that's what you believe, then you shouldn't be investing in anything, but including the S&P, and there's a lot of things. But I think real estate, as far as we can see out over the next 4, 5, 6 years, is a really still a great bet today.
Mike asked a question about, are there any gating provisions at the redemption window? And this is a great question, and it's a concern that's come up, not necessarily at Origin, and I'll go into why, but in general with private funds. So the answer is, in a PPM, managers have to have provisions that protect, importantly, the investor, right? And so the PPM is going to be done. I literally just texted our general counsel because I wanted to know, and it's in process, but I believe it's going to be done this week. So if you have questions about how soon this could happen, there will be a lot of interest in this fund, and it's a small fund, and this will be raised quickly, and we're ready to do that. But in terms of gating, there will be language in the PPM, but I can tell you historically it's never happened. And if you wanted a stress test, that did happen. The last few years have been difficult for multifamily, and a lot of our competitors, including the largest players, they had a lot of gating issues. We've had none. And the reason is, A, we've outperformed, and B, our investment partners seem happy with the level of return, service, et cetera. And so in this fund, I can tell you that if a lot of people want to get out, we'll sell all the assets. Let's assume everybody wants to get out. You have developments, you'll sell them, and it'll wind up being just a development fund. If some want to get out, we'll refi to let the folks out who want out, or sell assets if necessary, to provide that liquidity. So it's not a fund that would have gating problems anyway, because we have multiple ways to provide that liquidity. And then I can just tell you, historically, we've just never had an issue. I mean, it's never even really been on the radar, because people generally just don't redeem here, at least historically. But to answer your question, there will be language, because we need to protect the investor in the event that it's an extraordinary market condition. So I would be surprised if there isn't language in there.
Dave, I'm going to take 3 or 4 of these right away. So okay. I'm sorry if I don't pronounce your name. Mukul, will you provide a consolidated K1? The answer to that is yes. We will provide consolidated K1s when we can. Dave asked the question, is this new money only? Have any started construction? This is new money only, Dave. Nothing. We have not broken ground on any projects. We've only committed to them. Aaron asked the question, is the possibility of merging Growth Fund 4 and this fund just for the optional hold period? Yes, Aaron, that would be only for the optional hold period after all the assets become core assets. And then Ernest asked, can an IRA invest in this fund? Yes, Ernest, it might be subject to unrelated business tax income. So you can reach out to either one of us or someone in our IR group, and we will get you that answer. But I remember this came up on the call yesterday, and I believe there will be UBTI because there is no REIT blocker here. All right, Dave.
So Scott asked a question about the optional income target return. Yes, that's based on the dividend plus a natural growth rate of real estate, conservative, 2.5%. The dividend, we can't predict the future of interest rates, however, but in general, if interest rates stay where they are, we'll be building that dividend over time as rents go up relative to fixed debt, which will be placed on these properties. And so you wind up with that range that's provided. And that's also, anytime you think about core real estate, if you're getting a total return sort of in that 7 to 9% range, The historical there is 8 to 9%. So, it all kind of checks the box of what's completely defensible over long periods of time. That's what's interesting about multi is, up until very recently, meaning the last 2 years, multi kept up with the S&P compounded return. That has changed in the last 24 months because the S&P is up 50% and real estate's been flat. But I would also argue that's why this is an interesting entry point, probably too, on a relative basis. So it's something to think about. Go ahead, Michael.
Kevin asked the question about conflicts of interest between our various funds that do development. And Kevin, the only fund that there would be a perceived conflict with is between the Select Asset Fund and the Income Plus Fund. QZ is very simple. If it's a QZ deal, it goes in the QZ fund. It was sourced for that. Growth Fund 4, we're not sourcing for deals any longer. And the way we do this is simply on a rotational basis. The Income Plus Fund gets offered the deal, and if it passes or it takes that deal, then this fund would get the next deal. And Income Plus Fund is very easy to say. It has limited capital. So we have made a commitment to a deal recently for that fund, but that's how we manage that conflict.
Ron, thanks for your question. It's a good one. Is the basis better on development or acquisitions? I can tell you historically in 21, 22, it was very obvious that it was much better to develop than purchase. Existing housing or multifamily buildings were trading 20, 30, 40% above replacement costs. That doesn't make sense. In 23 and 24, some of the infill, high-rise, podium-built type construction was trading, let's say, 10% under replacement costs, and typically that's a better time frame to buy versus develop. And I would say right now we're transitioning to a non-arbitrage space where building or developing, buying existing or developing is very similar in its expected value. Obviously, you're gonna do better in the development because you're taking more risk than you should in a core building, but that's just an investor risk return bias. I'm pretty ambivalent on buying versus developing. And then, of course, when you ask a question like that, it's a broad question, but it ultimately boils down to a deal, right? And that's why we're looking at 100 deals, not 1 or 10 or 50. The deals we're doing, we're confident are much better to develop than to buy. But on the whole, it feels like arbitrage to me.
Dave, I'm going to grab a few in a row. Karen asked the question, can you use money from a 1031 exchange to put in this fund? The answer is no, but we do have a DST program. And if you want more information on that, you can reach out to David or me. And we're doing DST into the Income Plus Fund right now. Scott asked the question, what is the preferred return for this fund? That is 8%, Scott, and then it's subject to a 50-50 catch up on that 15% carried interest. And then Kevin asked the question, do you have to declare yourself a co-investor right away? Or if you were to start at $100,000 and decided before the fund closed to increase that to $500,000, then could you change your status? The answer to that is yes, Kevin. You could end up doing that, bringing it up, because as we bring people in, it's going to work the same way the fund. So we're going to allow people to come in until that $100 million. And then anybody who qualifies within that space can then provide that co-invest commitment as well.
Manan asked a question, are there co-investing terms available on other origin funds and strategies? Not in a systemic way. This is our first fund where we're saying systemically, you declare when you fill these documents out what you want to co-invest up to X. As Michael said, you might say, I want to match it with 100% co-invest, and it's likely you won't get the 100% co-invest. It'll probably be much less. But you're establishing on a pro rata basis what you will be given. None of our other funds have that feature. So, just as we try to innovate, if you're a client or partner of Origin for a long time, we didn't even used to invest in debt, right? We didn't originate loans, and now we do. And if you're an investor in credit, we converted that to an interval fund. And here we're introducing the idea of the free co-invest at a systemic fund level. My point is we're constantly trying to innovate. And the reason for that is we want to bring better products to you, the partner, because we think that, you have to evolve and meet that need. And sometimes meet a need that maybe you're not aware of, but then when you see it, you say, well, wait a minute, that is a better feature. I like that. And so we'll see how well this is received and whether you like this feature, and then likely if it's successful, and we believe it will be, the next select asset fund will have this feature too, but it's the first.
Dave, we're nearing the end here. Derek has a question. I might have missed the slide that showed given where the target areas are. The target areas are Sunbelt, so we invest in the Southeast, the Texas markets, and the Southwest, and this will be diversified across 5 different markets. So Las Vegas and Phoenix have been identified. We're looking at a deal right now in Nashville, and Dave talked about the pipeline a little bit, but more to come on those deals. But the idea is, we don't want this to be the Atlanta fund or the Phoenix fund or the Denver fund or anything like that. So we are going to do everything we can to diversify this across 5 markets. We cover about 14 right now, and we have a pretty robust pipeline, so that shouldn't be a problem.
Phillips asked a question, what's your go or no-go metric on yield on cost? It's a function of the quality of the real estate and the growth rate. But the yield on cost is a margin metric, meaning how much margin can we capture in development. We've never approved a deal in this environment that's below a 6.1 or 6.2 to our underwriting. So there is a sort of floor. But if it's exceptional real estate with barriers to entry, with high growth rates, and there's a compelling, we can trend towards 6.1, 6.2. Most of the stuff, as you see, is more like 6.3, 6.4. But just as I said earlier, it's very interesting to me, and you have to do it. So we're coming up with a base case 14 to 18 net IRR for the fund, but Michael and I both know the range is really 10 to 25. That's the range. And in the same way, if we're looking at a yield on cost, it's kind of funny almost that we're saying, oh, we'll do a 6.4 but not a 6.1, when we all know there's a range, and the range of outcomes is probably 5.7 to 6.9, but you have to do it. So you do it, but we don't know. All in a model is that it's wrong. You're certain of that. And we've done hundreds of deals now. I know that's true, but what you hope is that the range of outcomes isn't, that you have a pretty good idea of what that bell curve is.
Ernest asked the question, if you co-invest, does that result in 2K1s? The answer to that is yes. It's as if you're investing in 2 separate funds.
And Kevin asked a question about our co-invest. Kevin, it'll be significant. I don't like to share amounts anymore. We're very transparent on the website and our materials, and how much we've invested historically. And I just tell you that it's a little bit embarrassing, the whole thing. Like, I understand we have to do it. We'll be significant in it, but I don't want to do those types of things. And I think I'm speaking for you too, Michael, when I say that.
Yeah. Scott asked the question, thanks a lot. But what I was curious about is also, is there a cap on the 50-50 catch-up? Scott, I'm not sure I understand the question. The math behind that works out that the investor gets an 8% preferred return, and then anything above that is split 50-50 until we are caught up to that 15% return. So the way it would work, and I like to tell people, just very simply, if the fund generates, if we do our job and the fund generates a 20% IRR, then we get 15%. If the fund generates a 7% IRR, then we don't get paid anything. So the catch-up is sort of a math formula there. So it's not, I don't think it's a matter of whether there's a cap on it or anything, but it's subject to that 15% total carried interest. We can't take more than that in the fund. So email me if you have more questions. Hopefully I'm answering the right question that you're asking.
Last question just came in, and then I'll wrap us. Dino asked a question. Thank you. Can I invest with two separate entities to cumulatively reach 500,000 min and then co-invest? Yes, you can, and we understand, and we will treat you as one cumulative client in the same way as if you're an investment advisor and you have lots of clients that invest. We pool that to reach that minimum. So, we're here to work with you, and obviously we'll do that. So yes, we can do that. I'm going to wrap us up, Michael, unless you have anything else you wanted to cover.
No, all good. Thank you.
We value you as partners, and I hope you see that through our communication and the time that we spend. We believe that if you're very educated about every aspect of a fund, the management, the strategy, the historical returns, you'll be more likely to invest with us, actually. And we want you to be an educated investor that comes in knowing as much as you possibly could. So reach out to us. We have a large team. I believe we just crossed the 70 threshold, and that's also for you, for communications, for client service. And we'll make sure that you see and understand that. So love your feedback. Michael and I, we want it. So if you have questions, email us. And if you have feedback, email us. We can always improve. Thank you for your time. And I hope you consider partnering with us in this fund.
Thank you, everybody.